It's another record high on Wall Street. The S&P 500 hits a fresh new high today, right after we get the inflation reading that so many were worried about. Turned out to be just what we expected all along. But what do we do from here? Well, we got to start buying some more. And our guest today says you haven't seen anything yet. Welcome, everyone, to Buy, Hold, Sell. I am your trader, Todd Schoenberger, and I am joined by my friend and co-host, Tobin Smith, out in sunny and hot Scottsdale, Arizona.
It's
Toby,
sunny and beautifully warm today, okay?
Beautifully warm. You have the tan. You're showing it off. For people that are listening, you definitely want to watch this television show because Toby, he looks, I don't know, Charlton Heston. I'm telling you, you look great. Wonderful. Well, with us today is Scott Ladner he's a chief investment officer of Horizon Investments out in Charlotte, North Carolina. Scott, welcome to the program.
Hey, thanks, Todd. Appreciate it.
How's the weather down there?
Yeah, today is actually pretty good. It was in the 50s yesterday, but it's in the 70s today, so we'll take it.
I love it. I love it. How's it in Buffalo? How's it in Buffalo, Todd?
You know what? We had snow yesterday, Toby. It was awful. Absolutely horrible. My son's in North Dakota right now. It's 60 degrees. So I tell you, who knows? Who knows what's going to happen? But listen, people aren't tuning in for the weather right now, though. Scott, I'm going to you first on this. What do you think? We saw the inflation number come out. Everybody, I think, was, it's kind of like ho-hum, shoulder shrug. This looks good. We were expecting maybe we'd have some bad news. We did not. But what do you see for the markets from here on out?
Yeah, Todd, I think you said the right thing there. Like people were expecting some bad news.
I don't know why.
Kind of geared up. Well, like, look, I mean, just people are they want this rally to end. Nobody likes buying new highs, so on, quote unquote. Everything, psychologically, people think that's a bad idea. And there's this undercurrent to the market, undercurrent to the way people think about the world, where you're getting a reacceleration of inflation. We've never subscribed to that. I can understand it to some extent, but look, when you see housing prices driving, or basically the housing part of inflation driving the inflation print to be a tiny bit hot. When we all know that's not really kind of reflective of the reality on the ground, and we know kind of like this story had already been written. We're just reading the book right now in terms of the inflation picture. And if housing prices and shelter inflation is driving the inflation bus, we got a lot of confidence that's going to be done. So today I think it was just a more of a relief rally than anything else. Frankly, it just like it wasn't as bad as people were fearing it might be on the month-over-month numbers. And that that obviously unleashed some animal spirits again today.
Yeah, I am constantly amazed. We had our friend Jay Hatfield, who runs preferred equity funds and other stuff, but he's a monetarist. He's like the last monetarist on earth, I think. And I followed him for years, and he's followed me for years. And what he's been dead right about is that if you're using these equations that were come up with like 30 years ago, 40 years ago, to measure, well, we got freaking, everybody's got internet, everybody's got, of cell phones. If you wanted to get the actual price of what the equivalent rent would be, go on freaking Zillow, go on apartments.com. They'll tell you exactly what it is. But no, they take 42% of the CPI or CPE and make it shelter costs. And it drives me nuts. I mean, my favorite example was somebody originally from Southern California. He sold his house, his beautiful house in Laguna Beach for, I don't know, let's call it $10 million. The guy, it was like 3 years ago, the guy just resold it who bought it for $6.8 million. Now, does that get into the numbers? No. All the stuff, the crazy stuff that, made these rent equivalents year over year high, they're coming back to earth.
Yeah.
And the real inflation rate year over year is, I believe, the way I do the data, because I discount the hell out of that shelter thing. I mean, I know that's how the world works, but the real leading indicators, not the past indicators, the leading indicators have inflation doing this in this sort of, I hate to say it, soft landing.
Yeah. Well, I have to say, you might be right. We might be on with a soft landing or no landing. I mean, we have had some strategists that are suggesting there will not be any type of a landing because we continue to grow at a 2 to 3% clip on GDP. Scott, you're down in Charlotte right now. It's robust. People are happy. The weather's changing. You got UNC basketball going on. So many good things that are happening. Are you feeling it down there? Because I know in New York, a lot of people are concerned about expenses and inflation, but down there in Carolina, are people just happy? I mean, are you just thinking the good times are here?
Yeah, look, I mean, most people are pretty happy. Look, people still feel the inflation thing. Like
Sure.
you go to you just can't get out of your head the 2019 price of milk. I mean, like the pre-COVID price of milk, people it is just stuck in their dang heads, and they can't quite get over that. So there there is this difference between like the price level of things and obviously the rate of change of things, which is what we all most professionals care about, but most people don't really care about the rate of change. They care about the price of it. And that is definitely driving, like we've had this kind of buy obsession thing going for a while now, where all the data and all the the objective data with respect to the economy, the objective data with respect to people's like personal financial situations are all outstanding, and yet everybody felt like garbage. The answer surveys and they feel like absolutely like garbage. And it's got to be, there's the only explanation we can possibly think of is just this sort of this divergence between like the price of milk in 2019 versus what I'm paying now, and like things must be going off the rails because I hear about the debt all the time. I think that's a massive problem. I hear about like all the politics and all the division and everything else. I think that's a massive problem, and it's just driving people to feel not as good as they should. Not as good as they would have 30 years ago in the mid 90s, which we think is actually probably the right historical precedent that we're experiencing right now is kind of a mid 90s kind of thing.
Yeah.
And we think we'll get there, but this this sort of divergence in the way people feel, and the way they objectively are, has been really stark and interesting.
Yeah, the surveys also, again, I just find it very interesting. I make this point a lot that you think about the American economy, you have to understand that the bottom two quintiles, or really bottom 50% income, is barely paying the rent, doing the food, so on and so forth. I mean, it is a struggle. And then when prices went like this, and then all of a sudden they had to give up, maybe some luxuries, et cetera. I can see how that sort of poisons the well a little bit. But the top 25% of the households are now responsible for 78% of discretionary spending, and it's that discretionary spending in my data that says that's why we're so strong. And it's not fair. It's not fair. But it's like golf. It's not fair. The whole part of this economy that is so strong is the 63 counties that are responsible for 78% of all GDP, and the other 206 counties, on a relative basis, could all be flat, and we would still have a growing economy. And I think people just miss that.
I would think that a lot of that has to do with jobs. And, Scott, you had an interesting point in those notes that you had sent over about the recent employment report, the non-farm payrolls report that we received last Friday. You really broke this down because you got through some of the clutter. You're looking at a metric that some would say is probably the right metric to concentrate on. Explain to the audience, though. I mean, what are you seeing? Is there something, a slowdown, or maybe even more growth that maybe the headline number isn't really showing us?
Yeah, look, there is a lot of confusion around how to look at the labor market. We get surveys from like companies. We get surveys from households. We get purchasing managers types of things. Are you hiring? Are you firing? We get small business surveys. There's all sorts of data that comes with the employment situation, and it's the most important thing to figure out right now. Like, we think it's actually more important than the inflation picture right now because the inflation thing is reasonably obvious to us. But at the end of the day, what we try to do is make it just kind of bottom line it, and our bottom line is just something we just call aggregate payrolls, and it's pretty straightforward. It's just how many people are working times how many hours are they working times what are they getting paid. And this is sort of like national income kind of accounting, right? But that's if you just break it down to that basic metric, we're printing at about 5%, kind of 5% growth, and we've been there for the last 6-9 months, which is kind of like 2019, 2018 levels of that sort of aggregate payroll growth, which is healthy. It's not too hot. We were at 10, 11, 12% for that metric about a year and a half ago, 2 years ago. That was too hot. That was clearly going to lead to some inflationary pressures, which we ended up getting, obviously. But that has since calmed down. We are not at a too hot labor market at this point. And so that should end up giving the Fed some clarity, giving them some calmness, and leading to good things. But if you just look at that, this kind of distill the payroll situation down to how much money are folks taking home and making? We think that metric is pretty clear, and it's pointing in a good direction.
Yeah, my new favorite saying now, Scott, is 100%. You're 100% right. And that disposable income at the high end, because it's 72% of all disposable income. I also follow quite closely because that at the margin, as we learned in Econ 101, is where the trips are going. God knows I don't want to be in airline stocks these days, but at the margin, the incremental buying, the incremental revenue, the incremental business is coming from the top 25%, and it really makes a difference. And how some of these people come up with this, oh my gosh, we're going towards recession. They must not follow you at all, Scott, because you have it exactly right. That it don't get the complicated. Take the freaking data that's real time and do it in the aggregate and just chart it and just sort of see where the chart's going. Now, maybe if you were in just downtown San Francisco, the chart's been going down, but thank God that's not reflective of the entire country. But overall, we have a reindustrialization, inflection that's about, $15 billion a month. We have the decarbonization inflection. We have a lot of the reindustrialization. We have the offshoring coming onshore. We have all this stuff. I'm in Scottsdale in the greater area. We have 3 chip fabs being built, one by TSM or 2 by TSM, and 1 by Intel. They employ 49,000 people at an average salary of $162,000 a year, all in. Now take that to Tennessee, where they have it. Take it where they're doing that in Georgia. It's Todd, you're right about it's the centers that have the technology, that have the education, that have the natural resources are doing better. But to be these Debbie Downers, I don't know what David Rosenberg is smoking these days, but he
is negative.
God bless him, and I've known him for since the earth was founded. But I think it's because he's up in Canada. That's what I think it is. I think he's up in Toronto, and he just can't.
He's got something going on there.
He's got
something happening. Scott, what derails this rally in the markets?
So look, I mean, if we're wrong, it's possible. If we're wrong on the inflation picture, and for some dang reason the Fed needs to get going again, and they think they need to raise rates, irrespective of whether we think that's a good or a bad idea. If that ends up happening, that's gonna be a challenge. Because that's going to cause a lot more dollar strength. That's going to lead to this. Definitely not in the market. It's definitely not in the price right now. And so that could be somewhat challenging. The other big challenge would be if frankly, look, we don't love China. We think China's got a lot of challenges. They've experienced some of those challenges, but things can get worse. Like, they don't have to only get better. They could actually get materially worse there as well. That could lead to some unrest. That could lead to some unfortunate military decisions they might make from a wag the dog standpoint. That could lead to a whole host of things that would end up being bad for global growth, bad for global stability. So those are the 2 things that we think really could have a chance to derail things. Look, we think those are definitely outliers. Like, they're not on the base case at all for us. But if you're asking me for things that the flies in the ointment, so to speak, those are 2 at least of the known knowns that we've identified.
All right, you get a word point for wag the dog moment. I love that. Secondarily, then in this wag the dog sort of scenario, does that explain why gold is $2,100 an ounce today? Or is it sort of whispering, as everybody says? Is it whispering about our deficit? Is it whispering about printing money? Is it whispering about deficits, et cetera?
Toby, I think it's a really good question, because I think there's a lot of things going on with gold, and it's look, we are not gold experts. Let me start there. But the one way that we think about gold in an era of positive rates like we've got right now, in an era of negative rates is a different story. But in an era of positive rates, you can think of it as some sort of a fiat type of replacement. And if you look over a long period of history, gold typically represents basically the market cap of gold, or all the above ground gold times the price of it, is around a fifth of the total amount of fiat money in the system. That's traded, like non-reserve money. And that's about where we are right now. And so like, yeah, I mean, in terms of like gold being priced right, it's probably priced in the neighborhood of right, plus or minus like 15-20%. Like that's the level of my precision with gold. You know, that, so you know, we think it might be stepping out a couple of things. There might be a little bit of risk premium a bit to it. But overall, if you kind of like pull the lens out a little bit, it's probably in the neighborhood of right of being around the fifth of the market cap of the total fiat system money out there right now.
I think you're dead right. Obviously, if you look at what the Federal Reserve banks in the major countries, they have been buying gold. China's been buying gold like nobody's business, right? What I can't understand is, on a sector standpoint, why are gold miners going nowhere but south when gold prices are going up? If you look at the junior miners, the mid-sized miners, the big free McMorans, gold mining, I mean, I know it's an expensive business and so on and so forth, but it's a lot better at $2,200 than it was at $1,600, isn't it?
It is, but those companies and that sector, those companies in general suffer. You know, it is a capital intensive project, as you know, and these are not companies that finance themselves with cash. They finance themselves with debt, and debt's just expensive right now. Even with spreads where they are, debt's still expensive. The same problem that small caps have right now. Eventually, it's probably going to go away because, like you said, identity correctly. Like obviously, the price of gold is going up. These miners should be going up as well, but the cost to mine it is also going up. And so you know, if you think about their margins aren't really expanding like they should, because their cost of capital is going up just as fast as the price of the gold is.
You know, Todd, why do we have like the smartest guy we've had on in a long time? Let me follow up with one thing, which is Bitcoin digital gold? Man,
that is it's an amazing question. We actually spent a fair amount of time thinking through the Bitcoin thing, and if you think about it from the same perspective of like total amount of fiat money out there, it's probably, again, this is probably in the neighborhood of the right price here. It's a wild thing to say though, because like there is no pricing model for Bitcoin. There's no pricing model for crypto. I mean, like, you know, there's a reason why treasury bonds aren't very volatile, because everybody knows what the pricing model is, and all you have to argue about is what the inputs are. But you don't even know what a pricing model is for Bitcoin or crypto. So not only are the inputs, whatever they might be, very volatile, but nobody knows what the model is either. So there's no agreement on that. So there's a fundamental volatility to that stuff that's pretty wild. But the ETFization, like the ETF, making this thing an ETF, frankly, has made it like acceptable to CalPERS and to a lot of other institutions that there's no way they're going to open a Coinbase account. No chance. The risk reward there is terrible, right? But you buy an iShares product, they buy a lot of iShares products. So I
know that was pretty funny when he called, you know, Bitcoin crap coin for all those years, and all of a sudden now BlackRock has got the largest.
They can make a lot of money at it. So yeah, look, I mean, that you know, Bitcoin to us is one of those assets that you know, I think we're going to come down in the place where, you know, it can go to zero. I can make a cogent case it goes to zero. I can make a cogent case it goes to $400,000 too.
Yeah.
So like the left tail is truncated, the right tail is pretty extended, like, and it's not really correlated to very many things. If you just like take the characteristics of the asset itself, just like that. So we have a reasonable amount of data on it now. That's it. Like that's something that probably belongs in a portfolio at like a 1 to 3% weight, something like that. And you know, like just from a math standpoint.
Right. And I like your word about uncorrelated. You know, I'm looking at this portfolio that I run, and interesting, when Bitcoin's prices started going up, the Bitcoin miners were going up, and we did like stupid money in those things. But as soon as the ETF came out, my theory, Todd, here is that people said, why do I want to buy the proxy, i.e. the miners, when I can actually own the freaking ETF or own Bitcoin directly? So we own Ethereum because it actually does something. It actually runs systems, and that ETF we know is going to come out in March or April. But I love what you said about uncorrelated return, because I for a while there, when we were waiting for some type of pullback in our we called our AI tech stack stocks. I went to the post office on last Friday to get my passport renewed. At 9 o'clock, our NVIDIA deal was worth a few million. I came back, it was minus about $40,000 on that turnaround. I was like, that's the most expensive damn passport visit I ever, post office I ever went. But it takes us to the next point about momentum factors, because Bitcoin certainly, if you were to use all the factors in the equity markets, momentum would be number one, number two, and number three. Where are you on the spreading out of the market. The fact that, we own financials, because guess what? The stock market goes well. The trading houses do well.
Well, I'll tell you what, let's leave that question for the teaser, Toby, because coming up after the break, we're going to ask Scott all about sectors. He has some sectors that he likes and he has some that he dislikes. I think you're going to be really surprised on this one, Toby. So I was looking at these notes. It was definitely worth tuning into this show. All
right, as long as he doesn't like Boeing, I'm with him.
There you go. So with us today, we have Scott Ladner. He is the CIO over at Horizon Investments down in Charlotte, North Carolina. You can check out horizoninvestments.com for more information. And he's going to be with us right after the break, so please stay with us.
Buy, hold, sell, brought to you by CrossCheck Management.
Ready to up your game and learn more about the thrilling world of sports betting? Introducing Double Down with Breslow, the ultimate podcast about the business of sports gambling. Join me, James Breslow, and a long list of expert guests as we dive into the art and science of the sports betting industry. Evolving regulations, technology enhancements, and the meteoric rise in the number of players makes this sector the fastest growing and most intriguing in the world. Unlock the business secrets from many of the industry's most recognizable C-suite executives, including famous odds makers and influencers. Every episode of Double Down with Breslow is packed with insider tips, deeply skilled analysis, and in-depth discussions. Don't miss out on the ultimate resource for mastering the business of sports betting. Listen to Double Down with Breslow on the Evergreen Podcast Network or wherever you listen to podcasts. That's Double Down with Breslow, the business of sports betting podcast.
Another record-setting day on Wall Street with the S&P 500 hitting a fresh all-time high. Toby, it seems like every time we have a buy, hold, sell show, we're hitting a record high. There is a direct correlation here, and I don't know, I can't explain it any more than that, but all I know is that if you're watching on Biz Talk Today TV, or if you're listening on your podcast channel, this is a big winner, and obviously everyone's buying, so it's wonderful news right now for everyone, for investors.
That's the worst plug I've ever heard in my life, Todd.
I know.
Why don't you just hold up some money and say, we'll give you $10 if you just keep listening? Come on.
Hey, I'm not Joe Biden. Come on now. All right, well, with us today, Scott Ladner. He is the CIO of Horizon Investments down in Charlotte. Scott, I got to ask you, what exactly does Horizon Investments do for its clients?
Hey, thanks, Todd. Look, Horizon Investments, we're called a goals-based investment manager, and that's that's a kind of a catchy phrase, but at the end of the day, we work with financial advisors to construct strategies that really help try to power financial plans. So if you think what a financial advisor does, one of their big value props is creating a financial plan for their clients. But the distance between, the chasm between a financial plan and an investment portfolio is kind of wide. I mean, it's not obvious like what to buy to power a financial plan with all these cash flows, all these assumptions, all these wishes and dreams. And so the strategies that we manage, the things that we do fundamentally, basically fall into three categories. It's growing money, protecting money, and spending money. We call it gain, protect, and spend. And you can think about it like most basically, it's basically a deconstructed liquid variable annuity. And so an advisor can choose any one of those primary objectives to use with their clients, and really just basically build that bridge. Be the bridge between a financial plan and an investment portfolio. So that's really kind of the folks we serve, and that's how we serve them.
Well, that's great to hear, because many of my old days when I was a wholesaler, I would meet the quote unquote financial planners, and I wouldn't trust those people with a dime. I mean, in other words, their understanding of what they were doing was about like this, and to have guys like you that are able to actually fill in the gaps. Because it's a complicated world. 30 years ago, it wasn't quite as complicated, but it is now. So cool. Good to hear.
Yeah, definitely. So I know that your clients are probably going to you and they're asking you direct questions of, where do I actually put my money? I mean, you see a rising market. We talk a lot on buy, hold, sell about the $5 trillion sitting in money markets. I think that number is up to maybe 6 or 7 now. It just continues to rise, it seems, by the month. But with that, what are you saying? What are you saying to your clients? What are your favorite sectors right now?
Yeah, look, we are a global manager, so we do look around the world, but it's probably not a surprise to anybody right now. The U.S. is our favorite market, has been for quite some time. We think it probably will be for a while as well. Although Japan's got some interesting characteristics to it right now. It has for a bit, but within the U.S., look, it might be kind of boring because it's the most obvious thing in the universe to say, but but it's still tech and communication services. You know, our playbook is, you know, it is and has been for a while that this AI thing is kind of like the internet. It's, you know, it's easily usable. You know, this is not at all like crypto or blockchain or anything like right there. And those, like, I'm a pretty smart guy. I could not figure out how to use blockchain at Horizon Investments, but like we use AI here all the time for a lot of different things. Like, and it's super easy, right? So the ease of use, the ease of uptake in terms of like making productivity better is a really obvious case, just like the internet was, just like PCs were, in Excel. You know, if you remember the first time you tried to figure out Excel, it didn't take that long, and it made you far more productive than you were before. So you know, this mid '90s theme is really kind of where we think we are. So it shouldn't be any surprise that, you know, tech and comm services are still the things we like the best. But we think kind of the next generation, like second generation AI trade, which is really not. It's not, you know, it's not they're only showing me so many shares of NVIDIA you can buy. It is, you know, the second generation is gonna be like what companies are actually using these processes and this technology to improve their productivity. I think healthcare companies probably, you know, might have the best shot to have an easy, really large uptick in productivity with respect to, you know, figuring out drugs, figuring out testing trials, figuring out new safety protocols. Yeah, and like the drug I mentioned, the drug testing is probably the biggest thing that could be helped by these large language models. So, you know, we think healthcare could be pretty interesting. And then you know, one of the more boring sectors is your other favorite one, and that's the energy sector. But that, you know, that's because partly we don't see a recession. We haven't seen a recession for a long time. You know, and it's largely because we think people have the wrong framework for how to think about markets. It's not been we're not in a business cycle. We're in a war and a war recovery. So if you understand this, you know, the last 3 or 4 years is more of a war recovery rather than a traditional business cycle. We think it's, you know, probably get it more right. But in that frame, you know, that means that nominal GDP growth in the world doesn't have to go down. We don't have to go into recession. We don't have to have the down trough part of a typical business cycle. And that certainly is supportive of a, you know, a broad base commodity prices, and especially energy prices. And then you get the kicker of having, you know, a geopolitical hedge on top of it. If something stupid were to happen in Ukraine or somewhere else in the world. So, you know, so it's you know, it is those. It's the you know, the tech sectors, you know, healthcare and energy are our 3 top ones right now, at least in the U.S.
So energy, interesting, in that there are some players. I mean, look at Toby Rice yesterday. He went to go buy back Equitrans that they spun off. I used to be the most famous Toby, and then Toby Rice started being on CNBC every week, for crying out loud.
He pays you a royalty, though.
He does. We, for our income stuff, we're using some interesting things like liquefied petroleum gas tankers that they're not making any of right now. The rates are high because of all the things, and we're getting 28, 29% yields because the kids who took over from dad, you know, Giannopoulos, everybody was Greek, right? You went to the Marine meeting like I did in Athens, and all these guys are about 112 years old, and they're all sitting around with 28-year-old girlfriends, and they just, when they got money, they buy more boats. Well, those guys are gone, and the younger people now are, you know, professionally running these things. And so now you don't have that worry of, you know, Giannopoulos buying 25 more tankers because there's no more room to build them. You know, all the shipyards are completely full out till 2028. So I just want to encourage you, if you look at them, and then BW LPG is listing on the New York Stock Exchange in early April. So then we'll have liquidity in it. But these businesses are everything we love. There's an inflection of price demand. Or pricing power, because it takes 12 more days to go across the Cape of Good Horn than it does to go through the Suez Canal. That means longer trips. That keeps boats out of circulation. So rates, you know, go up 35, 40%. There's some very interesting things out there. I'm an inflection-based investor. That's what we do. But I never thought, I'm just looking at my thing here. In one of these portfolios, I'm just looking, we have $130,000 each of AVACF and BWLLF that are paying us 28% dividends. And they're up. We sold them because they just rocketed up. We bought them back, and now they're actually up like 20%, just the underlying. I mean, there's some interesting stuff out there, to your point about this is a post-wartime economy. And the business cycle goons who keep, you know, going back to like page 3 of Finance 101, that we're late cycle. We didn't have a cycle. We had a
Yep.
pandemic, and then we had an invasion of Europe. Well, the business cycle malarkey goes out. I don't know. It's another one. Todd, I'm getting angrier as I get older. I mean, it's just like, it's like, you know, and AI, by the way, oh my gosh. It's taking recording our talk right now. It'll send it out, you know. And
I can't. You're getting so angry. I can't tell if that's a sunburn or you're actually getting angry in the face.
I'm just kidding. It's really just the Celsius kicking in.
There you go. Go ahead. Finish your thought.
Yeah. So sectors. What do you think about financial? What do you think about brokerage? Do you break it down to subsectors?
We do sometimes. And financials, we're not being that cute right now. We actually don't love financials right now. But it's the reasons. There's a caveat to it though. So we don't love financials, one, because their trading businesses are still somewhat impaired. Like these guys just aren't making as much money as they used to because they're not allowed to take as much risk as they used to, right? I mean, like when we were doing this stuff 15, 20 years ago. We don't actually see a steeper yield curve anytime in the next 6 to 12 months. At least materially steeper ones, and that's it's a little bit of a headwind. The market thinks there's going to be a steeper. The steepener has been but everybody's favorite trade in the fixed income space for a very long time. It's not worked out so well. We think it'll continue to not work out great. We don't see it further inverting, but steepening is going to be a little bit of a challenge at least through the end of this year, we think, which is obviously a little bit of a headwind towards financial profits. And they're facing a little bit of competition from the private credit space as well for loan demand. So they're just a new entrant into that marketplace. That's supply. There's a competitor. And they're taking some time to figure that out. But the caveat though to this, Toby, is I just read about this today or yesterday was I guess ISDA's coming out with the recommendation that treasuries get a risk weighting of 0.
Right.
And that was news to me. I had not heard that, so it's not in that loop, I guess. But that obviously that would increase market making, that would increase trading, that would increase profitability, like kind of across the board. So if that does come to pass, or we think is more likely to come to pass, obviously those big banks, the trading center banks.
JP Morgan bond desk only does $18 billion a minute or something. I mean, some crazy thing.
Yeah.
I'm with you. We're long some of the Goldman Sachs, the guys with big trading houses, simply because of volume finally somewhat coming back. But they're not as dead sexy as LPG tankers, trust me. And the other idea that what we've been looking at is stock buybacks, because now that we're in this longer expansion, and don't get me on the yield curve, that how great has the yield curve been as an indicator of anything? No, it hasn't been. But yet I still see people on our competitive channels saying, well, the yield curve is telling it's told you the wrong thing for 4 years.
Yeah, it's been lying to you.
Come on.
It'll tell you something, but it'll tell you lies.
Yeah,
Scott,
right.
Based on your analysis, the issues with New York Community Bank and Signature Bank, do you think they're just one-offs, or do you foresee potential problems down the line for other banks?
Yeah, that's a great question. Look, we don't foresee problems down the line at other banks, and these seem to be kind of one-offy types of things. But I think it would be folly to sit here and be confident about that statement. The fact is, I don't know what's in. I don't have enough research time or frankly energy or interest to really dig in to some into the guts of some of these smaller banks. We don't think any of the big banks are in any sort of trouble at all. Period. End of story. But some of the smaller regional guys, could there be some skeletons in theirs in those closets? Yeah, I mean, there could be. I don't think they are, but there certainly could be. But the important part for us, at least, is that we don't think any of this, anything having to do with any of these issues, is systemic in nature. There's not an AIG that's about to go down. There's not a Lehman's about to go. There's nothing that is interwoven, intertwined across the economy. Even when you start talking about commercial real estate garbage, we don't see that as kind of a systemic type of issue. So it's not bothersome to us. But we don't think there's any more issues out there. But it's not. That's a low confidence statement.
Yeah. Also, there's the phone call that Steve got, the ex. I call him the CFO of America, our Treasury Department Secretary.
Munchin.
Munchin. There's a small group of human beings in the financial service business is when the caca hits the fan, that they get the call and they swoop in. I mean, it's a quid pro quo that's gone on since, I was back at Kidder Peabody in the 80s. But now, particularly after the great financial crisis, there's a phone call coming in on New York Bank, and that's how Munchin got involved in it, and that's how it solved itself so quickly. And I will tell you, we have some banks here that are owned by Bank of Utah, Arizona Bank, Share some other ones, and there's a fair amount of commercial space here. It's a growing area, but there's a couple of guys who are upside down. Those things got taken out in a day. I mean, there is an underlying strength of our financial system that is based on relationships, basically saying, you help me out, I'll help you out. And I think that makes us a lot safer than people are really, freaking out about. But the other thing is right, is Blackstone is making more money in private lending than the regional banks are by a factor of like 10. And their cost of capital is not much. So.
And before the audience starts sending in their emails, we do know the former Treasury Secretary's last name is not Munchin. It's Mnuchin, but we just like
Mnuchin, Munchin, they're all Munchins.
It's that we have our people that don't like us to mispronounce big names. Anyway, final question for you, Scott. Do you have an eye on the upcoming election in November? And do you see that causing a ripple or any type of an effect for the stock market?
So, I mean, in terms of an eye on it, like, it's too early, guys. I mean, like, it's in our view, it's too early. You can make a pretty sound case for either one of these candidates. Like doing well and winning the thing. I think it's reasonably close right now. But man, it's a long time. There's a lot of gaps to be had in the next 6 months. And do any of those actually hold or take or matter to people? Like, we'll end up seeing, but ultimately, the thing that I do tell people, when they ask me about it, because I'm sure, like you guys, we get asked about this for a fair amount. Doesn't really matter that much. We don't think it really matters. Like presidential elections, like they're really fun to talk about. They're super interesting to think about. They don't tend to have with some exceptions. They don't tend to have massive consequences. And we kind of think and this one is a little bit different because look. Trump won was a surprise because people didn't really believe that he's going to do the things that he said he's going to do, and now you just know like he's going to tell you what he's going to do, so just believe him. And so like I don't think there'd be any surprises on that front if he were to win. And a Biden wins, it's likely going to come in the form of a divided government, so he's going to be sort of neutered. And so you just kind of get the do nothing stuff. So we don't see this election as being consequential from a market standpoint that much, and this again can change as we walk through time and if policies shift or whatever. Right now we don't see it as a massive thing, but we know we're going to be talking about it a lot, just like you guys are.
Oh yeah, you got that right. Well, we're going to leave it there because I know we could go on and on about this. I mean, Toby and I have our own opinions, and I know there's a lot of strategists we do have, CIOs on buy, hold, sell that do like to talk about the upcoming election. There's all kinds of opinions, but that's what's so great. It makes a democracy.
They're both bums. Just keep it split so they can't spend any more money.
I like that. Well, we're going to leave it there, guys, because we are all out of money on this one because we can't keep the electric bill running any longer than we already have. But joining us with the show today, Scott Ladner, I got to thank you so much for coming on the show. We'd love to have you back on Buy, Hold, Sell.
I really appreciate it, Todd. Thanks, and thanks for talking to you, Toby.
Absolutely. So on behalf of Scott Ladner at Horizon Investments and Tobin Smith, host of the Money Mavericks program, I am Todd Schoenberger, and we want to thank you once again for joining us on Buy, Hold, Sell. We'll catch you next time. Take care.
Buy, Hold, Sell, brought to you by CrossCheck Management.
If you like Buy, Hold, Sell Live, be sure to smash the like button.
I want you to smash that like button.